This is CPA Berkeley video series. Today we are going to discuss Unit 5 and 6. Unit name is Financial Risk Management and Forecasting Technique. This is the unit which is related with BEC, that is Business Environment and Concepts. Broadly, we are going to discuss risk and return. We will learn in this unit what is the definition of a risk, and what is the relation of risk with the return. Along with this, we will study different risk attitude. We will discuss the risk averse, risk seeker and risk neutral attitude of the investors. Then we will see the higher the risk, it will create a higher return. So we will link this concept with the portfolio management. Surely we are going to discuss how to quantify investment risk. We will talk about systematic risk, unsystematic risk, default risk, liquidity risk, and we will increase our discussion in terms of diversification to spread the risk over the total investment. Then we will discuss beta, which measures the variability of the securities, and we will see how to value the assets. We will discuss the different models like CAPM and APT, and we will discuss the derivatives, financial derivatives, future, options, call, put. And in the second portion of this one, we are going to discuss the statistical techniques which we can use to enhance our forecasting quality and the projection abilities. We will start our discussion with the learning correlations and the regression. We will see how two securities are correlated with each other and how they regress each other. Then we will see that if we do the same work every time, our ability to do this will enhance, and the time required for this will be the less. So this will be through a learning curve analysis, and based on our past information, we will see the time series analysis by noticing the regular, irregular movements of the data, and it will give us a picture of any variable based on the quarters, years or months as the management is looking for. And then we will see the expected value, what is the owner expected rate, what is the probability to get. We'll multiply and we will get the weighted expected rate, and sometimes we can have a discount rate applications also. And in the last, we are going to discuss the sensitivity analysis to see that which items are sensitive for our business performance, and we can look around that issue in the more detail. Now we will start our discussion from our first topic, that is the risk and
return. Is any compensation for the investor that he is taking a risk. Any money you invest in any proposal, it is subject to risk of losing your money. So when you take risk, you get reward. Suppose you are doing CMA, you paid the tuition fees, you pay official fees, you have a risk. And this risk has an expected return. So in financial management, we have a bottom line principle. What is that? That higher the risk, higher the return. So same way we have investment attitude. Not everyone is willing to take high risk. Some people, they are very conservative. Even it's a matter of ages. When you go in the late ages, you become cool-headed, you become slow, you become conservative. You say no, whatever is coming is okay. But there is an age, 20, 25, when you're aggressive, when you want to create risk for you. You take risk, you stand up on the wall. People are watching you, you don't care. You don't have a fear to slip. You have a vision to go inside. This is your energy. So we divide investor in three categories. One is risk seeker, those who invite risk because they want to make too much money, high risk, high return. They want to play in stock exchange, they want to gamble, but they are interested for a high short-term return. This is risk seeker. Opposite to this, there are risk averser. These are those guys who want to avoid risk. They are very conservative. You know, they will go to the postal services, whatever saving they have, they will put it into it. Now, postal services or any government department which is considered to be more secured, they will give money to. And they are getting the lowest return, but they are happy. Their money is secure, they are getting small amount as a fixed, no worries. And in between we have risk neutral, means they are neither so keen to have an exposed risk, neither they are so conservative that they have only want to put the investment into a secured place where the return is lowest but the security is highest. So in between these are risk neutral guys. Based on three kind of investments, we have to see first of all our investor priorities. When you are a financial consultant of an investor, understand his mind. What is his mentality? Is he open to play? He is open to take the risk. So you suggest him high risk, high return stuff. If he say, okay, no problem, I can take the risk, if the idea is good, then he is a risk neutral. And if he don't want to take the risk, don't tell me these options, I don't want to go for it, just give me a secured option. So first of all, you should understand the psychographics of your investor based on your knowledge that this are the three types of risk and returns we have. Now, stepping ahead, first it was a style like 100 years before. Even we saw some coffee shops, we saw some shoes that since 1776, you know. Because it was a concept. You were doing one work since years. I mean, if you are selling shoes, you are a cobbler, you are making shoes shops and shoes shops only. But then the concept came, no, if you have one business, so one time it's going to give good returns, but maybe sometimes there's a slump season. When you don't have money, you don't have sales. So it gives you a concept to develop portfolios, different businesses by the same owner. Means if he sells the Chinese soup in the hot season, but in summer there is no sale because weather is hot. So these 6 months he will sell ice cream. So 6 months one business will make money, 6 months the other business is going to make money. If he is investing in real estate, he will invest in hotel, he will invest in tourism, he will invest in airlines, he will make a separate commercial plaza for the offices. So what you did, you spread his risk over different risk and returns. So you make a portfolio. This is called portfolio management. So if any part of this portfolio, one security, one share, one investment goes wrong, the other is there to cover him. So at the end of the day, it's a balanced portfolio which some option has high risk, high return, some options are conservative, they have limited risk and limited return, and in between they are risk neutral. So knowing the three type of investment risk and return, we make a portfolio, which is the whole process to understand is called portfolio management. This is today we are going to discuss. Then managing financial risk, first of all we should know what is a risk. Risk is an unexpected outcome for any future timings which you are not sure about. Few risks we know. We know that the accountant may be wrong. He is not entering the full data. AP is not paying to the right guys. AR is not receiving, he is receiving money, not depositing into the bank. He is taking by his own. And the financial controller is manipulating and playing with the company money. Business development manager is selling on low margins to their friends, and collection period has been granted very long. This all is expected. This is fraud risk, the transaction loss risk, the default risk, then currency risk. Currency might appreciate or depreciate. Then interest rates will change. 3 years before, interest rate was low, everyone was taking personal loans, and then it becomes double on the floating rate. So all the calculations change. So first of all, you should know how to identify the risk, and then you will start your process to control the risk. What is the risk? What is the return? Return is the compensation for an investor for taking a risk, is the amount received by investor as a compensation for taking on the risk on the investment. How we calculate in the formula terms is return on investment, that is ROI, is equal to amount received minus amount invested. You invest 100,000, you get 120,000. So 120,000 minus 100,000, 20,000 is the return on investment simply. Then we can take it in the rate form as well. We can divide return on investment with the amount invested. So we will get the rate of return. That's 10%, 12%, 15%. This is how it will be a starting point to see that the expected rate of return was, say for example 15%. We got 17%, so it's okay to some extent. Or we got 11%, which is 4% less. So what are the options? Then we will start discussing in the decision making process. There are broader, now we discuss two basic type of investment risk. Every investment can suffer with two things. One is the overall market situation,